Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 144th VideoCast, 134th podcast for the week ending July 21st, 2022. We will try to make this a quick one. I know I say that every week, but I think we've got a lot of good stuff to cover, but we'll get to it quickly. So to start with, quickly want to do the media. I want to thank Rochelle Akufo, Shauna Smith, Dave Briggs, Taylor Clothier, and Jeff Cohen for having me on Yahoo Finance last Friday. We'll cover that in the article of the week. Want to thank Phil Yin and Dalal Pektas for having me on CGTN America on Monday to discuss bank earnings. We'll get into that. Also want to thank Ruth Carson for having me in her Bloomberg article last week regarding the U.S. dollar. Maynaz Yasmin and David Henry for having me in their Reuters article last week regarding Citibank and the turnaround plan, and Zoltan Saranyi, AJ Fabino, and Mitch Hawk for having me in their Benzinga article, which you can find there. So the theme of this week to start off, growth stocks are worth buying when prices are reasonable. This is from Ben Graham, the legend that taught Warren Buffett, so we'll get into that. And we're going to do a quick aside. A lot of you have been asking me about my golf game lately. And I think it's interesting because when we did this article, if you haven't watched this, Chris Chandler, Legatum CIO and partner Phil Vasiliou, I interviewed their CIO a couple weeks back. And these brothers turned $10 million into $5 billion in 20 years. And one of the things that they talked about in the article in the Institutional Investor called Secrets of Sovereign, which you can find that article link right in the show notes on the interview here on the Hedge Fund Tips YouTube channel, is that when some of the positions were going against them and they were waiting for the positions to work out, Chris Chandler, I think, was more of a sailor and an adventurer type of guy, but his brother Richard took up golf because the most profitable thing he could do while he was waiting for his big positions to turn and ultimately become 5x plus was to pass time and not do anything and not get swayed by the day-to-day opinions, and to know that his research was done and know that these things were going to play out, which is a perfect metaphor for what has been taking place this summer, as we're seeing Alibaba and Chinese stocks have bottomed in March and are up quite a bit, and are obviously in fits and starts with the lockdowns, but the bottom, we believe, is strongly in. And then biotech bottomed meaningfully in May and are now up some 40%, and we think this is just the beginning for both trends. So we've been golfing, and as a matter of fact, we got a young guy is playing, I guess, D1 golf at USC. He emailed me. He says he's an avid listener of the podcast if I ever want to play. So we'll see when he comes to town, and maybe he can teach me a few things. I'll teach him about the market and he'll teach me about golf. But for those of you who've been asking about my golf swing, I guess it's summer. Everyone's interested. I'm on the other side of the trade. I'd not played for 20 something years. I came back this year. I've been playing now for 10 weeks, making great progress. And, I started with something our head pro teaches, something called stack and tilt, which is a controversial golf swing because it went against convention about 10, 15 years ago. But when you study all the greatest hitters of all time, they all either did stack and tilt before it was called stack and tilt. It's from the age-old book from the 60s called The Golf Machine, and then there were different iterations over time. First you had The Golf Machine, then you had this guy, Bob Grissett, the 10 lessons, the true fundamentals of the golf swing, which my pro actually gave me his. This is like the magic potion formula that all pros have that they never give to their students. So I'm very grateful for that, Gene. And then this book came out about 10 years ago called Stack and Tilt by Mike Bennett and Andy Plummer. And our pro at the course is good friends with Mike and Andy, so he's been doing it forever. And I started with Stack and Tilt. I got a lesson, and the next Wednesday when I went out at the course, it was like a murder scene. It was, and I had played good before that with my old swing, or good enough. So it was really embarrassing, and I quit stack and tilt, and on the basis of emotion. And what I realized was that, and actually my top client, who's a very good golfer, he explained that he used a modified stack and tilt. I was like, well, this is, one of the smartest guys I know in the world. I better take another look at this. And I did. And I went back to another lesson, and it started to click. So, so this is the swing from this week. By the way, the new clubs came in after 2 months. So if Mizuno can deliver some blades from Japan to Connecticut, the semiconductor companies are going to start delivering some chips to the OEMs, and that's going to be good for CPS, and we'll talk about that as well. So this is from this week. I got a little launch monitor, and this is a range because our range was closed because it rained like 5 inches, and if they keep the range open, the balls all go into the mud and they can't get them out. But so this is off by 20% the yardage, because these yellow balls are not like real balls. They're like dead range balls. But I talked to the owner and he said, yeah, just add 20%. So this was a 4-iron, about 214, 215, which is a little light, but it's about what? So this is what I switched to. I had originally had an upright swing, 2-plane swing with a lot of variables, which a lot of amateurs use. And I switched to this, where the tilt is this aspect, where you are tilted here 30 degrees, straight arm, straight wrist, arm tucked in decently, back leg straight. This is what most people don't like about the stack and tilt, but even if you look at Rory McIlroy, who technically doesn't do stack and tilt, all the hitters, even if you look at Tiger has a little more sway, but all the pros are doing this tilt with the front leg down, and it's more pronounced because I'm 6'5" to get down there. Head centered, and then with this swing, you consistently hit push draws, where you just bang it out and it comes in, push draws, and your divot obviously comes after the ball. So this is what it looks like after I stopped my emotional day trading of swings because it wasn't working for the first minute, and I decided to say, okay, what have the best ball hitters done in time? If you read this, Ben Hogan's 5 Lessons, you'll see that Ben Hogan was a stack and tilter. And you can Google YouTube videos, and it shows this exact swing from one of the greatest ball strikers of all time. So look, one size doesn't fit all, okay, but for me, I like something systematic with less variables, and when I'm not playing well, I can analyze it against a system. It's the same with investing in stocks, is once you've done the research and you know that it's proven, and your methodology is proven, and your analysis is proven, and all the, most successful people in your style have done it the way that you do. As a matter of fact, Carter was telling me, he was studying all of these. He basically went through the Forbes 400 and saw all the people that made their fortunes in hedge funds. And he said everything that they said that they did, and how they thought about things, and how deeply contrarian they were, and how they valued companies, and how they were patient, and how things went against them before they went for them and made them multi-billionaires, is exactly what you've been teaching since I've been listening to your podcast and VideoCast and working for you. And that was a big compliment. But, he pointed to Dave Tepper. He pointed to Carl Icahn. He pointed to Charlie Munger. He pointed to, Stanley Druckenmiller. All the greats, and the principles that the swing is not exactly perfectly the same, okay, but there are common characteristics. Even if you're not a stack and tilter, if you are a ball striker, that back arm is straight. You have this side tilt. Your head is centered and down, et cetera, et cetera, et cetera. And if you look at most of the great ball strikers, they play a push draw, which means the ball comes out and draws in a little bit, and obviously the divot comes after, but this was at a range. So that was that. And then on Thursday, with the new driver finally, yesterday, this was my drive on a par 4, 320. So just short of the green, albeit it was a short par 4. And just so you can feel better that I'm not bragging, I did not make birdie on this hole, which is an embarrassment, but it's part of the process. But again, you continue to refine, you continue to practice the principles that are proven. And I share this analogy because I'm going through in building my golf game from scratch per se, the same thing that many of you are going through in the investment process. Like, you want it to progress so fast and so quickly that rather than looking for proven, focused, measurable principles that work over and over and over throughout history. This stack and tilt is quote unquote revolutionary and brand new 10 years ago and controversial, but Ben Hogan was using it 50 years ago. The Golf Machine was written in 1962. Mac O'Grady was using it in the 80s. There's a reason, is because principles are universal. Bob Grissett, the 10 lessons of true fundamentals of the golf swing. So anyway, the point is that find what is proven to get the success that you're looking for. Have a style that works for you. If you modify it a little bit based on fundamentals, you're going to get the results. Look, Tepper's not the exact same as Icahn. Icahn is not the exact same as Buffett. Buffett is not the same thing as Stan Druckenmiller. But there were all underlying principles which Carter so aptly defined that ran through all of them that are universal. And it's the same with golf, and it's the same with any undertaking. So I think that's a good context to start today's call, and hope you found that helpful. Now, let's move on to some of the shorter-term indicators. I thought this note from MarketWatch, who did this? Steve Goldstein captured a note from Bespoke Investment Group. They're a good group of guys over there. I've known them, when I was at my first hedge fund, they came selling their research, and we bought it, of course, which was a smart move. So our call of the day, they're quantitative analysts, studies the link between corporate bond and stock markets. Spreads in both investment grade and riskier high yield bonds have narrowed rapidly over the past 3 weeks. This is key for a lot of things. Number one, for the equity markets, it's the most important indicator. But number two, our third largest investment in size, largest in terms of risk and to reward, depends on these credit markets thawing over the next 6 months. And we believe that's going to happen. All it takes is a run up in the equity market, which we think is starting to begin here. And we'll talk about that more. But analysts at Bespoke Investment Group study the history of such spread compression, though it isn't a long series since the popular credit default swap indices were only invented in this century. But it's over 20 some odd years. And what they said was, when they narrow this quickly, they're down the spreads are down 75 basis points in 3 weeks. Actually, in the last 12 years, on average, you're looking at the S&P up 22% a year later, which is also consistent with what we were talking about when the University of Michigan Consumer Sentiment Index got below 58 the last 3 times since 1980. The average returns were 20.87 over the next 12 months. So a lot of things pointing to the same results, but credit spreads are critical for everything we want to do and be focused on. So I thought that was a great article. This is from Jason Gopert over at Sentiment Trader. He says, in modern markets, the S&P has never lost ground over the following year when advancing volume was 87% or more of total volume for 2 out of 3 days, coming off a 52-week low. So he's saying that on that basis, the bear market's over. Again, we always say we don't deal in absolutes, we deal in probabilities. This is just one more arrow in the quiver for our bull case. This is the 10-day put call average. Okay, Seth Golden says every single S&P bottom has been signaled by the 5-day moving average of the equity put call ratio of 0.75 or greater since 2004. So he shows every single time that the 5-day put call ratio was greater than 0.74 all the way back, and it was a short-term bottom and in many cases long-term bottom. Here I drew up the 10-day. So just to be clear, he acknowledges that the indicator he's looking at got above 85.85 in June. So his indicator is triggered. I look at the 10-day, and as you can see here, when it gets elevated like this, the 10-day average put-call ratio, this is above, also got above 74. So not only did the 5-day, but the 10-day got above that. You see good things happen moving forward. Okay, next. Stock investors after brutal stretch have rarely been this pessimistic, so they point to positions in U.S. equity futures by asset managers and leveraged funds such as hedge funds as a percentage of open interest. Hasn't been this low since the big correction in 2016, and we know what happened next. You had a 3-year run after that. Also, net bullish option volume, so all those retail traders that were going bananas, they've all been completely flushed out. Last time bullish volume was this low was the pandemic, just after the pandemic low in April, which is interesting. This is just after what may be the low last week. We'll find out. Cash allocations among individual investors haven't been this low since the pandemic bottom, which is when you should have been a buyer, not a seller. I think it's a similar situation right now. They finally flushed everyone out. Moving along to China. Not sure why this logged me out. Sign in. Okay. Fine. Someone asked me last week, why didn't it sound good? I was like, because I didn't want to use this computer because I have to re-log into 100 different websites because for some reason it always logs me out. But nonetheless, in the name of sound and pleasing my amazing audience, I'm happy to log into 100 different websites every week to get good volume. All right, China's central bank governor pledges stronger support to the economy. Economy still faces certain downward pressures. Yi Gang says rising COVID cases pose fresh risk to China's growth. So, you know, we said this in March, and we said it in April, and we said it in May. You know, the bottom is in, but you're going to have fits and starts. There are going to be shutdowns. There are going to be, you know, after effects, aftershocks, etc. Expect it, but they're going to keep putting gas in the tank, and that's exactly what they're doing, and that's what we like to see. Bernstein upgrades Alibaba to outperform, so that's good. Opinion follows trend. Citigroup sees another 20% upside in Chinese stocks this year on spending stimulus. Hang Seng can deliver another 20% this year. They're obviously being conservative because they're still in the bunker. Wait until you see a big move in these stocks, the kind of upside they're going to be projecting. But now they have no choice. I mean, some of these stocks are up 40, 50, 60, 70%, even with the recent pullback, and they're flat-footed. So expect to see more panic upgrades and more panic buying as we move forward. Taiwan Semiconductor's revenue increases 43.5 to 18.2 billion in Q2. This came out last week. The most important aspect of this, revenue from IoT and automobile sectors grew the fastest with a 14% quarter-on-quarter increase. Automobiles chips from the largest chip provider to automobiles is a good sign, albeit it's up 14% year-on-year, and the comps were low last year, but it shows us that the supply chain is loosening up quickly. And as I said, if I can get blade irons from Japan and the new driver, and wedges, then car semis are coming next, that's for sure. China instructs banks to open the credit taps for developers, so more aggressive stimulus and easing. This is China adds liquidity for the first time since June as risks grow. They're going to do whatever it takes to get their economy back on track and attempt to reach their 5.5% growth target, which we'll see if they can do that or not. Chinese regulator defined Didi more than $1 billion over security breaches. This is good news because part of the crackdown and collapse of Chinese equities dealt with Didi. This is now resolved, so Move ends a year-long investigation and will free the firm to pursue a second listing in Hong Kong. So this is really good news because that's one more nail in the coffin. The final nail, when this is all over, will be the day you wake up and they say Ant Financial files to go public with Chinese Communist Party's blessing, and then it's over, and then you'll see money just flow in like it's like nobody's business, and people will remember there's what is $300 billion asset that, what is $1 trillion business Ant Financial will become in the next 5 years. Alibaba shareholders own a third of, which is more than the total market cap right now. So, just on Ant Financial alone, this stock is a double. And on the organic growth, we've always placed the near-term fair value at, 260 to 300. And we think over time, it's a $400 or $500 stock. And the only solution to benefit from that is to play golf and don't get distracted by the day-to-day headlines. China's top money manager adds Alibaba, Tencent, trims liquor stocks as fund beats market with portfolio tweaks. So I guess people coming out of COVID, they can stop drinking and start buying Baba, which is a good thing. Las Vegas Sands stock jumps as reopening hopes overshadow wider losses. I think this whole basket's a home run. We own these. Wynn, Las Vegas, Melco. I think they're going to be monsters over the next 3 years. Pent-up demand. Maybe they'll shut down Macau next week again. Who the hell knows? But again, buy quality when it's on sale. Go play golf. Macau casinos to reopen Saturday after COVID. By the way, any of you guys that are really serious hitters, if you see any flaw in my swing, I did send it to my pro. Feel free to put it in the comments below, like and subscribe. Anyway, I'm into constant and never-ending improvement here. I was really inspired by a friend of mine who I play with. He runs banking for a large bank in New York, investment banking, and he started golf 3 years ago. He's a 6 handicap, and he said that he dropped 18 strokes in 1 year when he bought this GC4 launch monitor, which shows you where you hit it on the ball. It's like a simulator. So I'm gonna get one and just start to measure every single swing and just get it done. And it's the same thing as investing. Universal principles: measure your progress, be patient, fits and starts, progress, steps forward, steps back. Keep your head about you. Realize, when you have a bad shot, how amazing it is to be out in the beautiful nature and sunshine and all of that stuff, and then get back to focusing on the principles, the universal paths, which we have a value tilt, the principles of Ben Graham, the principles of Warren Buffett, some of the growth principles we like, Phil Fisher, et cetera, et cetera. We've been through them over and over and over. Peter Lynch, Bill Miller, all the legends. There's a Lee Cooperman, the same universal principles, even if their styles are a little different. You got to have that tilt. You got to have the head centered. You got to have the straight arm back. You got to rotate the hips. You got to have follow through. And if you do all those things, you're going to get these beautiful, nice little crispy push draws all day long. All right, Macau casinos to reopen Saturday. Good news. Boeing's really interesting because as much of a shit show as it's been, everyone's forgotten about it now. And now as the good news is coming out, no one's paying attention to it. And that's probably the best time to buy the stock. You can never count anything out with this management, but it's still an oligopoly that's never changed. And even though they work 24/7 to try to screw it up, they failed because it's just such a good business. So Boeing sells some more Dreamliners. They sold a bunch more to an airline leasing company. So the orders are coming in. Auto stocks are down. They could be a great recession recovery play. This is from Jacob Sunshine over at Barron's. I'm more interested in the suppliers. Oh, here's the other order. Delta orders 100 Boeing MAX 10 jets, and then I think Air Lease ordered a bunch. So let's get to the article of the week so then we can catch up on some Ask Me Anything questions. Some of these are 2 weeks old. I missed a few, but we're going to get to all of them today. Excited about that. Chris Stapleton starting over stock market and sentiment results. Last Thursday morning, we published our article As Bad as It Gets, and so far that has proven to be true. Thursday marked... Oh, wow, look at the NASDAQ up 1% today. That's exciting. Thursday marked the near-term lows as I write this. The S&P is up almost 7% trough to peak. I guess that's now 8%. I got to double check that. And the NASDAQ is up almost 9%, maybe now 9.5%. Let me double check. Anyway, it's up a lot since that article. So you can see here, this was yesterday afternoon. Looks like there's some more juice today, at least in the NASDAQ. In 2021, country star Chris Stapleton won a CMA Album of the Year for, quote, starting over. the album and the song. We picked this theme for the article as the following lyrics may be pointing the way forward. And here are the lyrics. But nobody wins afraid of losing, and the hard roads are the ones worth choosing. Someday we'll look back and smile and know it was worth every mile. And if you think about all the billionaires in the Forbes 400 that have made it through investing and through hedge funds, that universal principle, every single one of them, the common denominator was they were buying something when it was out of favor and no one wanted it. Even John Paulson, if you read his book of the greatest trade ever when he bought the credit default swaps on the mortgage, he would go running in Central Park every day. So his golf was running, 10, 20 miles waiting for the trade to work. And then once he did, he made $20 billion overnight. And over the next 15 years through divorce and bad investments, he lost 15 of it, but he still got 5. And, world's smallest violin, he's managing to get along. So this is just consistently the same thing across the board. Dalio, Ray Dalio, no one had really heard of Bridgewater before 2008. They took that big contrarian bet and they were right. And then the money just flowed in and they've just been a behemoth ever since. George Soros breaking the pound in the early 90s. Dave Tepper, always contrarian bets. Carl Icahn, always contrarian bets, buying assets when they're out of favor, buying Tropicana in 2008 when no one wanted casinos, buying the energy stocks when they were out of favor, and then selling them recently. It's interesting. He bought them. Anyway, so the universal principles never change. Head down, centered, arm straight, tilt, rotate the hips, follow through, push, draw, crispy all day long. So, now, if we look to the Bank of America Global Fund Set Manager Survey from this week, we see that most managers are positioned, quote, afraid of losing, and as such cannot win. So, the hard roads are stepping in at times like these when others are selling in the hole, which they certainly have been in recent weeks. We saw it with China stocks bottoming in March. We saw it with biotech bottoming in May. And we may now be seeing it with the general indices in July. So this shows the XBI up 40% off the lows in May. This is just beginning. BABA up 72%. It's pulled back a little bit. This hasn't even begun. We believe these trends are just beginning, and the general indices may be next. As we frequently remind viewers on our weekly VideoCast, quote, amateurs deal in absolutes, professionals deal in probabilities. Right now, the probabilities suggest, but do not guarantee, better days are ahead for the indices. Here are the key measures of sentiment we are looking at this week, as well as how the biggest managers are positioned. Equity allocation versus cash, the lowest since October of 2008, lower than the pandemic lows. This is the lowest equity allocation since the GFC and the pandemic. Bears will say that the S&P fell another 30% temporarily after the October 2008 lows. They are the same folks who were bearish from 2009 to 2014 and missed a monster bull market before the pullback in 15 and 16. Also, everyone now believes we're going to have a recession. Look at the last 2 times recession consensus was this elevated and what the stock market did next. So the last time everyone was convinced we were going to have a recession was 1 month after the market bottomed in April of 2020. The market bottomed in March of 2020. The last time they were this certain there was going to be a recession was March of 2009. The market had already bottomed March 9th of 2009. So basically, you want to be, when everyone's convinced there's going to be a recession, is when you want to be buying the equity markets. Everyone now believes we're going to have a recession. Look at the last 2 times consensus was this elevated and what the stock market did next. Here you go. Boom. Boom. By the time everyone believes there's going to be a recession, it's already in the rearview mirror, at least the discounting of the market. Here's the secret. They were all right. All these people were right. We did have a recession in all of those instances, and we probably already had one, Q1 and Q2 negative GDP. I've been saying that for months. Here's the secret. They were right. We did have recessions in both instances, but the market is a discounting mechanism and priced it in ahead of time. the market rallied well before the recession was declared. That declaration could come as early as the end of this month when we see Q2 GDP. My guess is we'll have 2 negative quarters of negative GDP, which is a technical recession, and the National Bureau of Economic Research will not declare it a recession ahead of the election, and because they'll say employment is too strong. But the recession that the yield curve predicted months ago is probably already happened. That doesn't mean economic conditions can't get worse, but it does mean it's possible the market has already priced in that shallow recession that everyone's looking for. And if you look relative to previous recessions, this was a once in 100-year credit crisis, but this is a normal recession. This is a normal recession, etc. The other thing to be careful of is recency bias. Everyone thinks that because recent recessions have been so dramatic that the next recession is going to be dramatic, and it's just not the case. Historically, prior to the last 20 years, recessions weren't as always as pronounced as we've seen in recent years, and I think there's reason to believe, having just had one 2 years ago, this one's going to be, or was, if we had it in Q1 and Q2, more mild. Okay, now look at the positioning. The number one cash position among about 300 managers managing $800 billion is cash. Here's the last times that they've been that bearish and then that much cash was the exact wrong times. Did you want to be a buyer or seller in April of 2020? Same thing in October of 2016. Same thing after the Euro crisis. Same thing after the Great Financial Crisis. Same thing after the tech wreck. So these are times you want to be buyers, not sellers. It doesn't mean it can't go lower. There are no absolutes. There are probabilities. It just shows when positioning is, there are no sellers left is basically what it comes down to. Equity allocations versus cash, the lowest since October of 2008. That was a real recession. That was a reason to be this pessimistic. Even if you're bearish and you think there's going to be recession, I think most people are sensible enough based on corporate and consumer balance sheets to recognize it's not going to be a recession like 2008, where we came inches from going off the cliff if the correct interventions weren't taken quickly enough. So to see us worse than the pandemic when we had no vaccine and no antivirals and no clue as to what could happen moving forward is mind-boggling to me. And this is just a function of behavioral science, recency bias, and mistaken positioning in our view. Managers' largest positioning is cash, highest since the 9/11 terrorist attacks. All this money will be panicking back into the market as quickly as it panicked out once the tide turns. No one is positioned for any good news at present, whether geopolitical, earnings, or inflation. When something clicks, everyone will be waiting for the next shoe to drop and miss it, just as most missed the pandemic lows in 2020 when we put out this note a couple of days before the low. And you can pull this note up on MarketWatch. Sean Langlois has put it out, and we were showing how the market was overdone. The Dow was down 35%, and even in 1918, it only went down 33%. And we were buyers, and that was a perfect bottom call. And you just have to, study universals, study the basics. There's nothing new under the sun. This stuff, what works, has been working for a long time. You don't have to reinvent the wheel. You can call it something else and pretend it's new, but if you go back 50, 60 years, all the greats were doing the exact thing that's repackaged under a brand new name. So on Friday, I joined Shauna Smith, Rochelle Akufo, David Briggs on Yahoo Finance to discuss my stock market outlet. Thanks to Taylor Clothier, Jeff Cohen, Shauna Smith, Rochelle, and Dave for having me on. Here were my notes ahead of the show, which the University of Michigan consumer sentiment came in at 51.1. Since 1980, the last 3 times it dropped below 58, it marked the lows in sentiment and the peak inflation. Average S&P gains 12 months later was 20.87. Other point I covered is that while the Fed is tightening, and we'll get to 75 this month probably, in the background they're being very accommodative in that they were supposed to do 47.5 trillion of quantitative tightening last month. They only did 7.5 trillion. I'm sorry, 47.5 billion. They only did 7.5 billion. And the reason is, if you go to the Beige Book, they see there are signs of slowdown in demand, they have been successful at destroying demand, which was their objective, but they don't want to destroy the economy. And that's why you have Waller coming out saying 75 bips is enough to get us to neutral. And that could be the end of it. It could potentially be the end of it if we get more, if we start to see those commodity prices at the cash register in coming months. Maybe September gets paused, or maybe one more and then gets paused. But once that pivot happens, the bottom is for sure in. Earnings continue to hold up. This is an important point, which I shared with, I guess it was Presley, who had questions about earnings takedown. And I said, would you rather sell 10 hamburgers at $10 or 8 hamburgers at $15? Companies are still passing through costs. Earnings have come down in real terms by staying steady in nominal terms with 8% inflation. So $250 of earnings for 2023 is the equivalent of $230 without that 8% inflation. So the big estimates takedown that everyone's looking for with bated breath has already happened in real terms. It's not to say, more won't happen in nominal terms, but that's already a big takedown. And I think the problem most analysts are having is they haven't dealt in this type of inflation environments. They would have to be like 80 years old right now in the business, which is unlikely, to have seen an environment where in real terms you had the numbers takedown, but in nominal terms they stay elevated. And that's what we get paid on, is nominal terms. So that's the name of the game. Okay, so we talked about groups that will do well in a slower growth environment, biotech and value tech, and we like, obviously, China tech. We talked about Taiwan Semiconductor beating on the bottom line, top line, and raised guidance. Good look on auto chips, up 14% year on year, which means shortage is abating, which equals a glut of new cars will be coming and collapse new and used car prices, which is a huge component of CPI, I think as much as a third. So as those prices come down due to the chip glut coming, we're going to see a huge reduction in CPI in addition to the commodity impacts, etc. Even J.P. Morgan, Jamie Dimon, who called for an economic hurricane, said that the consumer and corporate balance sheets are in great shape on the earnings call. No cracks yet. And finally, option skew measures the cost to insure catastrophe. Deep out of the money puts and calls, 1 and 2 standard deviations. VIX measures at the money. The skew is down at pandemic low levels. Why? Nothing left to insure. The house is already burned down. It happens near inflection points historically. When everyone stopped insuring for major catastrophe, i.e. the smart money, then you want to be a net buyer. When the dumb money is at the money, the VIX is still elevated because retail people are buying at the money protection at the exact wrong time. CGT and America, this is a great interview. We covered quite a lot in 7 minutes. About housing. A lot of you have interest in housing. Take a listen. Bank earnings and banks. Take a listen which banks we like. And Fed policy moving forward. So thanks to Dilal Pektas and Phil Yin. And then finally, sentiment is thawing. Bullish percent moved up from 26 to 29 this week. Bearish percent dropped down from 46 to 42. Still fear, but thawing. CNN fear and greed still at fear, but thawing at 39. You can see there. And finally, National Association of Active Investment Managers. This was at 26.74 last read. This means that active managers missed the rally, almost 9% now in the NASDAQ since last Thursday. They've missed it. They were all in cash. Now any unexpected further positive news will force them back into the market aggressively. They now have to chase up because they have career risk. Some key things that we didn't cover in the article from the Bank of America Global Fund Manager Survey. Global growth optimism is lower than at the pandemic, lower than during the Great Financial Crisis, just to give you context. Profit optimism, lower than the Great Financial Crisis, lower than the tech wreck. Inflation expectations coming down. That historically meant lower interest rates. That's a good thing. People think the Fed will pivot when U.S. inflation PCE deflator drops below 4%. Investors no longer expect higher bond yields. That's a good thing. If that credit market unfreezes like the bespoke survey we saw, number one, Cooper Standard will get refinanced. Number two, the market will work its way to new highs over the next year, and we'll be back off to the races. So the cherry on the sundae would be if we got the recession data at the end of the month showing that we had 2 quarters of negative GDP growth, then it's rear view mirror. Economic data can get worse, but we've already had the recession. We don't have to worry about, the yield curve inverted. Are we going to get it next year? We've already had it this year, which would be fantastic. And God forbid they actually declare it, then it's over. From a stock market standpoint, from an economy standpoint, you'll see unemployment probably jump another %, but not the end of the world. Managers taking higher than normal risks is lower than at the lows of the near the lows of the great financial crisis. So it just goes on and on. I mean, there's never, like, if you had dropped me in from space at any random time in the future and I saw these gauges, I'd just say, how much money do we have? And, I'm not a leverage guy, but how aggressively can we leverage it? Because you only get these opportunities when there's a washout this big. Do the math. We just covered it once, 2 or 3 times every decade. So you can wait for more confirmation signals because nothing's absolute. But on a case by, we've not been wholesale buyers of indices, but we have been aggressive buyers of things that work. And the 2 things that we've been aggressive buyers from have already bottomed: China in March, biotech in May. And now we're waiting on Cooper Standard, which is a bespoke special situation, which is basically a super levered play, one on semiconductors, but more than that on credit spreads. That's basically all it comes down to. And with God's help, spreads have come in 75 basis points in the last few weeks, coincident with when we started the position. So that's good news. Sometimes good to be lucky and to be good, but I'll take luck any day of the week. Biggest tail risk: inflation stays high, global recession. Most crowded trade: long U.S. dollar. This trade will unwind before the end of the year. You can be sure of it. We started to see signs of it this morning when the Lagarde raised rates. I think the big turn in this is going to be, as I said, with Ruth Carlson and Bloomberg, when the Bank of Japan stops defending the 25 basis point yield cap on the 10-year JGB, and that goes to 50, the U.S. dollar will probably drop 15% in a matter of days. And it's just a matter of time because they're not going to be able to hold it together much longer. But we'll see. We'll take it as it comes. These things often take longer than I expect, but they eventually and always do work out. Okay, Carter put together some earnings. The reason we remain relatively unemotional through all this noise is because we continue to burden ourselves with the facts. And we go through every sector. We do 2 sectors a week. So every 90 days, we've done the entire market plus and some subsectors. And, we see earnings are stable here. So in terms of this week, Carter did REITs. Estimates in the last 60 days for the top 30 weights were revised cumulatively up 1.56% for this year, 1.18% for next year. Utilities also flat for this year, negative 2 basis points for 2023, plus 3 basis points. So, and over that period, the market's down a lot. Let's look at some economic data before we go to the Ask Me Anything questions for this week. All right, we saw building permits were better than expected. Housing starts were slightly worse. That's understandable. Rates have gone up so quickly, they'll back off, and supply will come on, and we'll see a change in this. It's just going to take a little time, as I discussed with Phil. Crude inventories were a draw. That's good to see. Existing home sales were a little bit weaker than expected. So look, you're seeing a decline in demand. That was expected. Continuing jobless claims ticked up. This is what the Fed wants. Initial jobless claims were higher than expected, 251, so that's ticking up. This is all consistent with a mild recession, which we believe we had or are having, and that's a good thing because the market has done a decent job of discounting it already. So into earnings, this is of last week. We'll see what happens at the end of this week. Earnings came in a little bit from 250 to 248. That's pretty common before earnings season. You see the same thing before last earnings season, from 230 to 229 for this year. So you're getting a little bit of nominal takedown, but nothing like what analysts are calling for yet. Okay, let's get to the questions of the week. This is from Rich C. Thoughts on Borg Warner, similar industry and macro tailwinds to Cooper Standard. They have made several major accretive acquisitions in the past couple of years to make that historical comparison somewhat challenging. but the pro forma would suggest a lot of upside when the new car market rebounds. Strong moat, strong balance sheet, well-positioned EV, all metrics at historical lows, pays a 2% dividend while you wait. Probably not as much upside as CPS, although perhaps not as risky considering their balance sheet. 100% agree with everything that you said. This is a higher quality business with less operating leverage and less upside, but more stability and a lot less upside. So, yeah, I've got nothing wrong. I think it's the same thesis. If you look at their, cash flow per share, this is a compounder. This is a decent quality business. Earnings per share, they've been compounding over the last decade. Even book value per share, they've more than doubled over the last decade. Revenues per share, they've more than doubled. So this is a steady grower, and the stock has done nothing in that time period. So yeah, this is a bargain. I would definitely be interested. You're not going to get a 10 or 20 bagger on it for damn sure, but it's not inconceivable this could be $100 stock in the next 3 to 5 years. So yeah, I think this is good research. And the other thing that I like about this is I see it in the results. I don't even need to look at return on equity and return on capital, but you can see the return on equity has been, historically 20% a year. It's now getting back to that. This was a temporary impairment, not a permanent impairment. Same double-digit return on total capital. Nothing to really think about here. If you've done the balance sheet analysis with all these, it's just solvency analysis, and we've been very clear on Cooper Standard. We think there is a risk of a donut hole, but it's something that you manage by size. And if we're right, which we think we will be, that the semiconductors come in over the next year and a half, and which we're already seeing, and credit markets unfreeze, which we've seen a nice move in the last 3 weeks, they'll get refinanced, and this thing will be $20, $30 overnight, and then from there, it'll take 3 to 5 years to be $100 plus in our view when we get to a normalized $250, $300 million of EBITDA. So, $9 a share in earnings, 10 to 20 times multiple, et cetera, et cetera, et cetera. Okay, Bob Johnson on YouTube asks, can you present your thoughts on ARKG, which is Kathy Wood's biotech ETF, or Innovate Genomic ETF? Seems like the only ETF from Kathy that has potential in my time frame. All right, so... all right, so what are the holdings of Kathy? By the way, I met Kathy in Tampa during COVID at a restaurant. She's a wonderful person, and I hope she sees great success. By the way, for everyone beating up Kathy Woods, I would say this. The ARK ETF and Berkshire Hathaway have had identical performance since the inception of the ARK-K, her flagship fund. So just keep that in mind. As much as obviously it's been up and it's collapsed and some of her viewpoints have been unpopular, she's still performing pari passu with Berkshire Hathaway's performance over that period. And Berkshire's had Apple, which has been, the vast majority of its gains. So I would never count her out. I'm looking at the assets in this ARK Genomic thing. Vertex makes money. I think CRISPR is okay. INSEE is okay. These are it looks like she's somewhat upgraded her holdings from more speculative non-earning businesses to more of the staple biotech. So this one's probably okay. I'd be more comfortable with the XBI personally. We've been talking about that since, for a few months now. That's the way I would play it. I think the tilt here is more companies that don't make money and don't have the cheap valuation metrics that we've discussed. So if this one works, maybe this will have more upside, but I still like the XBI over this. But I think this one will potentially be okay as well. I just haven't gone into as granular detail as I have with XBI and equivalents. So, okay, Raman Deep. Hey, Tom, any thoughts on the Alibaba Cloud Shanghai data leak report? I covered that last week, but I'll cover it again. Let me just get the other question here. Pedro Martinez asked the same question. Dear Tom, in your last episode, you mentioned Baba's news that something was wrong in the code Perhaps this article helps clarify major difference if this is true. Researchers found that the database itself was secure, which is important because the executives from Alibaba were meeting with the Chinese government to explain what happened. And what Pedro is saying in this Wired report, you can go to wired.com, Chinese police exposed 1 billion people's data. And that's important. Here's the link. I don't think you can see it, but anyway, just go to Wired and type in the words Chinese police exposed 1 billion people's data, and it will come up. He says, researchers found that the database itself was secure, i.e. AliCloud, Alibaba's part of it, but that a management dashboard was publicly accessible from the open internet, allowing anyone with basic technical skills to grab the information without needing a password. So it sounds like the police screwed this up. They'll never admit that because the police is a government entity. But even if it was the worst thing, like Alibaba screwed up, I pulled up, just to put things in context, again, separating the emotion from the reality. Here are the top 10 data breaches in history. Yahoo breached $3 billion accounts from 2013 to 2016. It didn't matter. No one cared. At the end of the day, what happens is they pay a fine. They say it's fixed, and everyone goes on with living. It's going to happen. Then there was Aadhaar breach, 1.1 billion Indian citizens. First American Financial, 885 million records in the U.S. They're still doing great business. Verifications.io, 800 million records breached. Equifax, everyone remembers, 605 million records of 147 million people breached in 2017. Your credit reports. Facebook breached 540 million records in 2019. I don't even remember this headline. That's how much it impacted Facebook. Like, no one cared. They probably paid a fine and on to the next. Marriott data breach 2018. I don't remember this headline either, and I read a lot of news. 500 million records. Friend Finder, I don't even know what that is. 420 million breach. U.S. voter data breach 2017. Definitely don't remember that. 198 million records. So these things happen all the time, and it's on to the next. So maybe the Chinese government, they're a little tougher, but worst case, it was Alibaba's fault. They'll pay a fine, promise it's fixed, on to the next. The stock will be down. You know, it's down on that, by the way. That's the newest fits and starts. That, you know, but now it's stabilizing. So if it was Alibaba's fault, it would be in the headlines the next day because the Chinese government would be throwing them under the bus. It's the government's fault, just like it was with that Boeing crash in China. You just never, it just goes away. You don't hear. There's no resolution like, we were wrong. It was actually the Chinese police messed this up, or the Chinese government. You'll never hear that. It'll just, you won't hear Alibaba screwed up. Like, it'll just go away. Just like you didn't hear, oh, it wasn't Boeing. It was the pilot was on a suicide mission. You know, you'd have to dig hard to find that article. I did, obviously, because I wanted to see the resolution. But it's never like, you know, Boeing exonerated in crash. That headline doesn't exist. It just goes away. Same thing's going to happen with this breach. Okay. Hi, Tom. Hope you're enjoying your well-earned weekend. Thanks for your hugely informative podcast, VideoCast. I particularly appreciated your excellent illustrations of stock surges, large pullbacks, to be able to recognize these and not get shaken out. Great content and essential to be aware of. I wondered about your opinion of adding to Boeing, Amazon, Wynn Resorts, JP Morgan, all appear at reasonable valuations with catalysts. Wynn seems particularly beaten down, negative 49%. Yearly change, 4 times down from 2018 highs. Amazon looks good also. Would you see any as preferable? I listened to the CGTN interview. There are 3 banks that I would rather have over JP Morgan, and I explained the reasons why to Phil. Wynn I love, Amazon and Boeing I all love at these levels. I have good allocations to China Tech, Biotech, CPS, etc. Best regards, Drew. So, yeah, I think you're spot on, and I can tell you've been listening for a while, and I know you've been listening for a while, and I like your setups there. Jacob Reynolds, huge fan of your work, have been a long believer in your BABA hypothesis. However, I am curious if the recent joint announcement by the FBI and MI5 have impacted your opinion on regulatory situation. Good question, but again, this is just more noise. MI5 FBI chiefs warn over China in rare joint address. The heads of MI5, this is from 3 weeks ago, by the way. Federal FBI warned Wednesday about China's commercial espionage thrust in the West in a rare joint address at the British Intelligence Service London headquarters, speaking to an audience. Today we're running several times as many investigations as 1980. Hostile activities happening on UK soil, et cetera, et cetera, et cetera. But Alibaba doesn't do that much business in the West. Their international business is Southeast Asia and parts of Eastern Europe like Turkey, et cetera. It's a non-issue. So hope that answers your question. Great insight, Patrick. Great insight on how to progressively exit positions. Every week I learn from your channel and the insights you provide. Thank you. Unless I misunderstood what you said, you have discussed how you think the market may be at or near bottom. The Buffett indicator, however, indicates that the market may be about 35% higher than the fair or historic average. Do you take this stock market valuation to GDP model into account, particularly in light of the likelihood that GDP could fall given the possibility of a recession? So this indicator doesn't work. That's why Buffett hasn't talked about it in 22 years. There's a good article you can Google. Buffett's favorite indicator is wrong. Here's why, from Andrew Hessler. There are a number of factors. One is there are less public companies today than there were 22 years ago. Part of that's because Sarbanes-Oxley was a complete disaster, knee-jerk reaction to the tech wreck, which caused companies to not go public or to go public much later. And that's why you see more opaque stuff in the secondary market than you do in the primary market, which has hurt capital formation and probably set the country back. Unintended consequence of not well thought out regulation. And then two, she lays out this case. Let's use Apple as an example. The numerator for corporate equities to GDP metric is essentially market capitalization, which is a statistic we can find for any stock. For example, Apple's market cap is, she wrote this a couple of years ago. Apple's market cap is about $1 trillion. The company notably became the first, GDP, the denominator in this ratio, is the total output of the economy. We could think of that as sales for a company, since sales are a measure of the company's output over the last 12 months. Apple sales are about $259 billion. Taking those two figures and applying it to our metric gives Apple a ratio of 388%, pretty overvalued. But here's the kicker. Buffett has been buying Apple for the last few years, which would indicate that he doesn't believe the stock is overvalued near current prices. In fact, last year, the Oracle of Omaha told CNBC he likes Apple stock so much he'd own 100% of it. So we can probably stop thinking of this as a useful indicator for stocks, and it's probably not overly useful for valuing the stock market either. And there's a big reason for that. This type of analysis ignores potential growth, profitability, etc. Apple's worth $1 trillion because of its profitability, not because it delivers services on it, etc., etc., etc. So these type of stocks are always misleading, and you know when someone's trying to deliver a message that's inaccurate when they do it in arithmetic scale versus logarithmic scale. It's what all the bears do. And most of them are CMTs that should know better, but they're trying to communicate a point that's false, and it misleads a lot of people that don't know any better. So I agree with this. Look, we'd always like things to be cheaper, which is why we're not wholesale buyers of the indices. We're buyers of individual stocks and sectors and special situations that are out of favor, that we feel we have an edge from our research and our time arbitrage and our stomach. And that's probably the most important edge that we've had over the years, is our emotional fortitude once we've done the work. So with that said, I'd like to thank everyone for listening in this week. We actually got it in under an hour. Hope you found the metaphors helpful. We'll be back next week, same time, same place. I'm off to a 3-day swim meet for my 8 and 10-year-olds who are crushing it, and we're very proud of them. So wish us luck over the weekend. It's a big regional zones age group thing. All the swimmer parents will know what that means. And we'll see you soon. So until next time, make it a great one. Bye for now.